So without further ado, I just wanted to turn it over to our host for today. We're joined here by Equitable with some amazing insights on segregated fund contracts. We're going to navigate the segregated fund space, which I think is a nice timely topic in today's climate, with looming tariffs getting imposed, but also the threat of that 30 days. It kind of goes from day to day, it seems like almost. So some of these protective measures that segregated fund contracts give you might be great for your clientele. And then we also have a few key updates and a few insights that are going to be delivered from Philip Cowie on the PAR product with Equitable Life as well. I know PAR has been a big focus for a lot of our advisors, and Equitable has been looking tremendous as of late. So I want to turn it over to our two hosts today, Sadaf Chowdhury and Philip Cowie, to take you away. So Sadaf, I think you're starting us off. I'll turn it over to you.
Thank you, Brett, for the generous introduction. And hello, everyone, wherever you are. Good morning, good afternoon to all who join us from coast to coast. It's interesting, Brett, that you've mentioned tariffs, because when I was working with Lara, in order to see what topics we're going to discuss about, and I was supposed to focus mostly on the learning side. I tried my best not to cave in and talk about all the headlines, and more importantly, I was trying my best. I promised myself that I'm not going to talk about the T word. Could be Trump, could be tariffs for you, but that was my promise to myself, but I couldn't resist. And with everything that's going on in the last couple of weeks, it's something that I have had to incorporate in terms of a market commentary of what we're hearing from our fund managers. So there's a little piece of market commentary, 5 to 10 minutes I'll start off with. And obviously after that, we'll go on to the learning section, which is really understanding the key stakeholders of a segregated fund contract. And then I'll pass it over to our Director of Insurance Sales, Philippa, who will be talking about some of the enhancements and updates on the PAR side with our life insurance product. So without further ado, again, thank you everyone for joining. Yes, so I've had a lot of advisors in the last couple of days and weeks as well. We're a little bit worried about what's going on. We haven't seen a hostility from our neighbors down south, at least in the last 4 years. So they're a bit concerned about how it's going to impact the markets, how it's going to impact the Canadian economy. And we got fresh news from the press yesterday that the initial tariffs, as you know, that the blanket tariffs that were promised by Trump on just a few weeks ago were postponed. But yesterday, news came out that he is going to be slapping a 25% tariffs on steel and aluminum imports from Canada. And this is without any exceptions. So he is pretty insistent that he will not retract from this executive order, and he will go on and impose these tariffs. So advisors and a lot of clients are asking what's going to happen, what's next after these tariffs. And I guess the right question in a situation like this is not it's a good question to ask what's going to happen, but the first question that we should ask ourselves is how much substance do these threats, these tariff threats or border threats, or the 51st nation threats, I'm sure you're hearing that as well. How much substance and legitimacy do these threats hold? We've seen President Trump in the White House 8 years ago. It does feel like a deja vu, 8 years back, a lot of headlines in the first few months. He's done the same thing before in his first term. A lot of empty threats, a lot of headlines. We got to understand this is not about the policies. It's a lot about the figure in itself. President Trump, whether you like him or not, we can all agree to the fact that he is very unpredictable in what he does, his actions, and a lot of what he says. He likes to cause chaos and a lot of noise and headlines because it puts him in the center of attention, center of everyone's talking points. He thrives in those kind of chaos because his primary effort right now over implementing all these executive orders with his personality is trying to make sure that he shows all the American citizens that he is making everything happen that he promised on. So there's going to be a lot of words, a lot of claims, a lot of threats to other countries, even allies in the next few weeks and months. But the question is, what does he really follow up with through? So, the blanket tariffs, obviously that proposition is gone. Now we're moving into steel and tariffs on steel and aluminum. But even this exact situation happened 8 years ago when he took over the office in 2016. He actually imposed tariffs on Canadian steel and aluminum. But a few months later, this was all retracted and amended through the NAFTA USMCA agreement. So we are expecting, hopefully through enough pressure, that these tariffs later on, there's a lot of market participants and analysts who are expecting these tariffs to be retracted again, because not only does it hurt the Canadian consumers or the Canadian economy or the Mexican economy, but it really also impacts the US economy and more so the US consumers, because inflation's still pretty hot there, and any tariffs imposed on these key materials and precious stones is going to have a dwindling effect on the overall price in the US economy. But we still have to be very careful and prepare ourselves. These threats might be empty. It might be a part of his negotiation tactic that he always claims himself as the chief negotiator. But again, worst case, if anything happens, if he decides to go mad and just put a 25% blanket tariff, it is going to be quite hurtful for the Canadian economy. If you look into the two pie charts on the left, you will see that around 33% of Canada's GDP is reliant on exports. And out of that 33%, the US covers 77% of all our exports. So technically, any exports going to the US, it can hurt around 28% of our economy, which is on GDP, which is huge. And the industries that are going to be hurt the most is obviously oil and gas, especially in some provinces, Alberta, BC, Saskatchewan. But automotive vehicles, especially in Ontario and Quebec, there's a lot of manufacturing plants for automotive vehicle machinery. Right now, if you look at the last two items in the right-hand chart, you will see aluminum and steel. So those are the ones where Trump is right now imposing tariffs. Out of a $440 billion of export basket in Canada, we are looking at a $20 billion goods where tariff is going to be imposed on. So it's about 4% of the total Canadian exports, which is not significant, but it still can have obviously some certain more strenuous impact on certain industries. So it's better than what we initially expected, blanket tariffs on everything. But I think a lot of the market participants are quite they're hoping at least that this is just a threat for Canada to control its borders or whatever the administration is expecting, and we're expecting retraction from this later on in the next few months. Now, again, lots of headlines, lots of news. Tariff is a centerpiece right now, but obviously there's so many things going on. This is the key message from this presentation, or at least outlook. Again, the fund managers have been saying this as well for a long time. Good news is we've seen this before in the last Trump administration. It's nothing short of a drama. Every day you see and hear something, and markets do react to it. You will see some volatility. But even in his last administration, the markets ended up on the long-term picture doing very well. And we're expecting even this time, I think as long as you are agnostic to all the noise and all the headlines and invest in sound and good companies, you will be just fine. And there's a lot of reasons to be optimistic and positive about at least 2025. And this is more so an overview of the US economy right now, because most of our funds, our segregated funds, are invested in US companies. So the US economic backdrop looks very positive and favorable. We got low unemployment. At a time in the last 3 years, I'm sure it's been a roller coaster. We've seen COVID, we've seen inflation rise up, interest rate rise up, and now we're seeing interest rates go down, inflation going into back to normal levels as well. Through all these episodes, economic episodes, most of the developed economies, Canada, Europe, Australia, etc., Japan, it's still struggling to keep up and get out of the recessionary phase that it was pulled into. And the economic outlook is not that great in those countries. But US has been by far extremely resilient. I mean, unemployment remains low there. the economic growth remains robust, and consumer spending, which is huge, has actually increased over the last 3 years, which really is a testament to how strong and resilient the US economy has been through a lot of these hurdles. And now that these hurdles are sort of getting eliminated or getting moved out, it creates a better outlook for us in the next few years. More importantly, you are invested in companies through these SEC funds, and you're invested in the stocks of this company. So what really matters at the end of the day is the bottom line, is the earnings, is the profit. So in terms of corporate earnings, good news again, corporate earnings growth and outlook in the last few months and going forward is also looking very extremely bullish. And there's a few reasons for that. Obviously, firstly, the US dollar remains very strong. There's increase in efficiency through the operations of this business through AI. So AI on a retail side, we are not seeing the full effects of AI. Maybe ChatGPT is the best at the retail side, our everyday Canadians like us know about. But once you dig deep and look into the business operations, some of these big and small businesses are really ramping up on their AI adoption, and that is helping them increase efficiency and at the end of the day, lower costs as well. So their profits also are looking positive from there. And this new administration is also looking to be more pro-business in the sense that they do forecast, or we're expecting them to lower corporate taxes as well as provide more deregulation in the industry. So as a business owner or as a corporation, there's more growth fueled. It's a more pro-business environment in the Trump administration. So overall, if you're invested in good companies, I think there's a lot to be happy about. There are some risks, obviously. There's tariff and trade wars. Inflation can resurge if the economy remains hot. And obviously, we got geopolitical uncertainty. But to end off my market commentary right now, this is something that I'm very excited about. There are some catalysts this year that might trigger in a new wave of growth in investments. AI, artificial intelligence, is something you've been hearing about for the last at least 1 year, if not two. And obviously, it's coming into full fruition now. But there's some key industries or sectors that are being the beneficiaries of the boom in AI, and one of them is infrastructure. With this increase in AI technology, we're seeing a lot of data centers to store all the data that we're collecting. So a lot of data centers are now being built to obviously power these data centers. A lot of electrical grids are also being constructed, obviously to power electrical vehicles. That also comes into play. So infrastructure will be a very interesting sector to look into in 2025. Digital finance is going through a breakthrough as well with blockchain technology, and also this administration's more pro, I would say, crypto. So we might sort of look into some breakthroughs in that side. And we got quantum computing, which is my favorite one because it's in its very, very early stages, and a lot of our fund managers are exploring the opportunities, but it's in its very early stages now. And this is quantum computing essentially is what we use today, the computers that you use today, times infinite, or not infinite, but a million times faster than that. But again, we're in its early stages, but there's a chance we can make some breakthrough from this technology as well. So these are some catalysts that should make you feel excited about some of the companies that you're invested in through Equitable and through our fund managers. All right, now shifting gears, let's move on to the learning side. I picked this topic today for a few reasons. On the surface of it, it is basically talking about the key stakeholders of a segregated fund contract. And it might seem very simple on the surface of it, but there's a lot of nuances sometimes that goes into seg fund contracts, and especially if you're an advisor who's probably more insurance focused and you do have these one-off investment cases and you're looking to understand who the key stakeholders are. This is very important to understand. I still get a lot of advisors reaching out to me who are pretty savvy on investments. Even myself, I struggle to understand the role of each of these stakeholders. But more so than the role of these stakeholders, it is also important to understand how these stakeholders, or what's the optimal way to structure a sec fund contract or to design a sec fund contract based on the needs of your client. So let's move into this. With segregated fund contracts, we essentially have three main constituents. So these are the folks, or these are the constituents that need to be in a sec fund contract, or else you won't be able to open up a sec fund contract. So we need an owner, we need an annuitant, we need a beneficiary. I'm sure these are very familiar terms for you, but you need these three separate constituents in order to open up a sec fund contract, or else you won't be able to open up a sec fund contract. So what is an owner? Who is an owner, right? And what responsibilities what is the role of an owner? So owners are essentially the ones who are dictating some of the terms and conditions of a sec fund contract. They have the ability to assign beneficiaries. They have the ability to assign annuitants. They have the ability to make changes to the contract later on. And more importantly, they are responsible for the taxation over the life of the contract. So they have a lot of, obviously, they are the chief and primary constituent in a sec fund contract. And ownership can come in many forms. Obviously, the more common one is individual owners. And individual owners can open registered or non-registered contracts. However, there's ownership can come in joint ownership format, as well as a corporation can own a sec fund policy as well. But for joint owners or a corporation, you can only open a sec fund contract through a non-registered means. But for individual owners, you have no restrictions. You can open up a registered contract or a non-registered contract. And then we also have, on the ownership side, we have the successor owners. And this is where sometimes we try to understand, how do successor owners fit in a sec fund contract? Well, successor owners, firstly, they are obviously, as the name suggests, they would be the owners of the contract upon the passing away of the primary owner. So if the primary owner passes away, the successor owner takes over the entire responsibility of the contract and all all the functions of the contract. And the reason why people appoint a successor owner is the most important one is to make sure that the primary owner, upon their death, the contract is not taxed to their estate and it's passed on to the successor owner. And it's a very easy transition. If you don't have a successor owner, sometimes settling that contract or estate can be very tricky. But if you do appoint a successor owner, the control of ownership and the transfer of ownership is very seamless, and you also don't get dented on taxes on your estate. It does get moved on to the successor owner. If that's your objective, obviously, that's how you should set up the contract. So yeah, just something that you should be aware of. Now, annuitant is the section where I get most of the questions, because at first glance, owner and annuitant, I'm sure they're the same person. And you are right, in most cases, the owner and annuitant in a sec fund contract is the same individual. It's in 80% of the time, it's the same individual. But there is some slight differences. And the textbook definition of an annuitant on a sec fund contract is the someone upon whose lives the whole contract is based upon. So think about, in terms of life insurance, think about life insured. That's who the annuitant is. So this is an important component. The annuitants play a very important role because since we are constructing the contract based upon the annuitant's age and life expectancy, the contract actually ends as soon as the annuitant is deceased. And it is for the same reason, it is very important to understand that once you're constructing a sec fund contract, make sure you don't appoint the annuitant and the beneficiary as the same person. Because if the annuitant passes away, the contract ends. Now, obviously, if the beneficiary is the same person as the annuitant, the beneficiary does not end up receiving anything. It goes it flows through the state of the contract owner. So just one thing to be mindful of, regardless of what type of policy it is, registered, non-registered, make sure the annuitant and the beneficiary are not the same people. Now, I've mentioned this before. In most cases, the annuitant and owner are the same individuals, but this is this is true in the sense that for registered contracts, the contract owner and annuitant have to be the same person. That's the rule in this case. So for any registered accounts, RSPs, TFSAs, FHSAs, RIFs, you have to make sure that the owner of the contract is the annuitant, because the contract is registered federally under their name and SIN number. But for non-registered contract, you can actually have a separate owner and a separate annuitant. And you might ask, why do people do that? We'll actually explore that in a bit. All right, so with annuitants, that is what an annuitant is. What makes it a bit more confusing sometimes is when we hear a successor annuitant. We've heard owner, successor owner, annuitant, and now there's a successor annuitant. So, why appoint a successor annuitant when you can just appoint a successor owner? Now, a successor annuitant, actually, we see a successor annuitant come in only or mostly on registered policies. So for RSPs or TFSAs, that's where we see a successor annuitant come in. The reason is the owner and an annuitant in a registered policies have to be the same individual. So oftentimes what they do is to extend the life of the contract. If anything happens to the owner of the contract or annuitant of the contract, in order to extend the life of the contract, they appoint a successor annuitant. And the most common scenario where we see this happen is in a traditional family. You have two spouses and they have two kids. So what happens is, if one spouse has an RSP, or let's say a TFSA, and they want to make sure if anything happens to them, the death benefit doesn't get passed to the kids. They want to make sure that the contract of the TFSA, the life is extended, so as long as the surviving spouse is alive, and only when both the spouses are deceased is when the kids receive, or the beneficiaries receive, the death benefit. So essentially, the primary objective for appointing a successor annuitant in a registered contract is making sure if anything happens to me, I have my wife who this contract will be based on as a successor annuitant. And only in the case where my wife or myself and my wife are deceased is when we want the death benefit to be passed on to our kids or to the beneficiaries. So that's when you see successor annuitants come in. Other than that, we don't see a lot of situations where successor annuitants come in. It's only mostly for registered contracts. Now, I was mentioning about common question from advisors. Non-registered contract, you can name an annuitant and an owner separately, like they can be separate individuals. And you might ask me, why would someone do that? What are some of the situations? Situations would be if you are someone who is, let's say, over the age of 85 or 90, you won't be able to open up a sec fund contract in most cases. And with most insurance companies, we do have restrictions on age where we take in deposits. So if you are someone who's 90 years old, you want to open up a sec fund contract, but you cannot due to your age, what you can do is you can open up a sec fund contract or design it in a way where the 90-year-old individual is the owner, and they can appoint someone younger, let's say their spouse or their kids, as the annuitant. And hopefully they're under the age of 80 or 75. But essentially, the life of the contract will be based upon the age of the annuitant, which in most cases, if you're over a certain age, you would appoint your younger spouse or your young kids. Because in that case, you will be able to open up a sec fund contract, plus you will be able to make deposits, but the life of the contract does end not when you pass away, when the annuitant that you appointed passes away. And in sec fund industry, we call it borrowing an annuitant. I'll give you some example of this in a bit. All right, so beneficiaries. This is the more easier one to understand. Obviously, this is one of the key benefits of having a sec fund contract or having a sec fund instead of a traditional estate planning or mutual funds, for example. You get to name beneficiaries on a sec fund. So it's very, very easy on the estate planning side. But as simple as it sounds, there are a few things that you need to be mindful of when appointing beneficiaries. Obviously, something that has to be said, you can have primary beneficiaries as well as contingent beneficiaries. Contingent beneficiaries are basically backup beneficiaries. So if the primary beneficiaries predecease the contract owner, the funds will be flowed down to the contingent beneficiaries. But what is important to note with beneficiaries are that at the end of the day, they are the last recipients or the last in order the recipients for the death benefit. They're the ones who receive the death benefit in cash when all the other stakeholders pass away or are changed. But when you are appointing beneficiaries, when you're sitting down with a client, be very mindful of how you appoint revocable versus irrevocable beneficiaries. As the name suggests, obviously revocable beneficiary, you can, as a contract owner, you can change, if you appoint a revocable beneficiary, you can later change those beneficiaries without their approval or signature. So essentially the beneficiary has no say when changes are made to the contract. But if you appoint irrevocable beneficiaries, um, not only will you need their approval when you're changing beneficiaries, so you'll need their signatures, but even for small things, even if you're trying to make withdrawals out of a contract, or if you're trying to make some changes into the contract, you will still need the permission, or you will need the irrevocable beneficiary to sign off in order to get that approval. So make sure if you are going for an irrevocable beneficiary, you understand all the implications that come with. All right, so let's move on to quick case studies. Obviously, there's a lot of things I've covered, but when we go through specific examples, it really helps us understand when a client comes to your office and when you really see them in a certain scenario. So um, the first case that I want to explore, sort of go over, is the most simple one that you will get in your office. And this is, it's RSP season right now, so you might actually get a lot of these kind of cases. For registered contracts like RSP TFSA, there's a very simple structure. Owner and annuitant are the same person. So ownership, there's only three stakeholders: owners, annuitant, and beneficiary. And owner and annuitant are the same individual, and beneficiary usually is, their beneficiaries. Could be their kids, their spouse, their estate, their other family members, but it's very easy to set up this contract. And let's go through a quick example to see, we have Sarah here, who is an owner of a sec fund contract. And the best way to design this contract, she has a husband, she has a child as well. And the best way to set up a contract for someone like Sarah is to, obviously, since this is a registered contract, she has to be the owner and the annuitant. And then she has decided to select John, her husband, as the successor annuitant, because if anything happens to her, the contract will be moved over to John under the life of John. And the contract will only end and the proceeds will only be paid out when John is deceased, when both Sarah and John are deceased. So the kids will only receive the payment when both the parents are deceased. In this way, again, if Sarah did not appoint John as a successor annuitant, what would happen is if Sarah passes away, the proceeds are going to be passed down to the child. So John will not be able to really have any control or say on that. Okay, in terms of taxation with registered contracts, one thing to note is when a non-spouse is named as the beneficiary, the value at death of a sec fund contract is taxed to the owner of the estate. Whoever the owner of the contract was, their estate will be the ones that are going to be levied with the taxes. However, if the spouse is a sole beneficiary, the spouse may elect to get a tax deferred rollover as part of the RSP or TFSA or FHSA. So it's an important consideration to think about when you are appointing beneficiaries. Non-registered this is another scenario for non-registered accounts, and this is another easy one because the possibilities for creating a non-registered sec fund contract is endless. Like you can really play around with different possibilities depending on the structure of the family, right? So we got another typical family. We got Paul and Mary, who are Paul and Mary, who are married, and they have two children here. So in one case, they can do a joint ownership where they're both the owners, and they can elect each other as a primary annuitant and a successor annuitant. Now, obviously, the beneficiary will be the children. If they don't want to do joint ownership, they can elect to do or structure it in a way where the husband Paul is the owner, Mary is the successor owner, and the annuitant are both of them, and the beneficiary's children. But it's very easy to construct a non-registered sec fund contract because there's a lot of ways you can do it. And lastly, we have borrowing and annuitants. So this is where, you won't see a lot of these kind of cases, but you on the off time that you see, it's important to understand how you can make use of it. This is going back to non-registered contracts where the owner of a contract and an annuitant are two separate individuals. How can you or when can you utilize a strategy like that? This is a classic case. So we got someone coming into your office. Name is Joe. He's 86 years old. He wants to invest in Equitable sec funds. Unfortunately, our deposit age has a maximum limitation at 85. So he won't be able to be an annuitant of a sec fund contract. So what he does is he opens the contract under his ownership, but he appoints his his child Sally, who let's say is 70 years old or 60 years old. Now, Sally is the annuitant of the contract because it's based on her age and on her life that we are constructing this contract. So even though Joe is over the age of 85, he can still open up a contract as long as the child Sally is the annuitant. And obviously, as you can see, I've mentioned this before, make sure the annuitant and beneficiary are two separate individuals if we are, at all times. They cannot be the same ones. So Joe has named himself as the beneficiary because if anything happens to Joe, no problem. Sally takes over the contract and she would be able to, be the beneficiary of the contract. If anything happens to Sally, if Sally actually predeceases Joe, then Joe will actually get the proceeds of the death benefit because, yeah. All right, so we've gone over these scenarios, these stakeholders. There's lots of ways we can structure a product or structure a sec fund contract. At Equitable, we have all the three main types of sec fund. We have all the three main types of sec fund contracts available. So we have the 75-75, we have the 75-100, and we have the 100-100. So investment class, estate class, protection class. In terms of resets, we allow one reset every calendar year, which is done manually, and we allow resets up until the age of 80. So as an advisor, when you hear manual resets, yes, it's you have to keep track of it. It's not automatic, but if you have a list of 10, 20, 30 high net worth clients, it's a very good opportunity for a good news call, because if you see that the markets are doing very well and you can apply a reset anytime, you can give those clients a call, tell them, hey, Sally, your market value is up 10%. Let's lock in a reset. That helps build that relationship and the trust with between an advisor and a client. So lastly, let's look into the just a little bit snapshot of the funds, and more importantly, why Equitable? Why should you work with Equitable when it comes to your investment needs? We offer segregated funds. Obviously, that's the bulk of our offering, but we also offer a very competitive product lineup on the GIA side as well as annuity side. But why work with us? Obviously, we're rated very high in terms of financial strength, but more importantly, we're one of the very few mutual companies still out there. that are operating. And this is something that I want you to understand, because mutuality, it sounds like a very, very flowery word or very fancy word to label ourselves, but there's a lot of meaning behind it. Unlike public companies that obviously have shareholders as their first or primary stakeholder, a lot of the dividends, a lot of the retained earnings and profits are used to appease the shareholders, right? So you got to cut corners, you got to cut costs and make sure the shareholders derive the maximum value. In a mutual company, there's no shareholders at all, right? We have only stakeholders. We are more community driven. So any retained earnings or profits that Equitable generates, most of it is passed down to your clients, the policyholders, is passed down to our advisors, our business partners, and it's also passed down to us employees as well. We somehow are the beneficiaries of Equitable success. So it's a very community driven company, and that's what makes it special. There's some ways where we obviously pass this down to the clients through some great funds, through reduced MERs, through enhanced rates on GIAs and annuities. On the life insurance side, Philippa is going to cover our very competitive par offering as well. We also reward our advisors, and I'll actually go over that in a bit, how we reward our advisors. But Equitable's success story over the last 4 years, both in the insurance and investment side, has been phenomenal. Like, this is our net sales in the last 4 years. And since 2020, we have quadrupled our net sales from $200 million to now last year was $803 million. And in terms of gross deposits, last year Equitable surpassed $1 billion on SEC fund deposits, $1.6 billion to be exact. So we were one of the top providers out there in terms of getting in new deposits. And this is a very powerful slide as well. Equitable Investments in the industry had the largest percentage of year-over-year growth in segregated funds. So last year was a story of growth, was a story of breakthrough for Equitable on the investment side, as well as the insurance side, which Philippa will cover. A few things about our fund lineup at Equitable. 90% of our funds are managed by external fund managers. So we believe that we should outsource the expertise to people who have been doing this for hundreds of years. And that's why we rely on our partners on the fund side: Mackenzie, Fidelity, MFS Dynamic, Franklin Templeton, and Invesco. They're the ones who are managing around 90% of our funds. We also have our own Equitable Asset Management that has some in-house funds available as well. And with that help, we received a few awards recently in the Fund Grade A+. But this is also a snapshot of our top 6 funds in terms of performance. I'm just talking about raw returns. If you look into the top 2-3 funds, the year-to-date performance on the very right speaks volumes of how strong these funds are managed. But 1 year can always be an outlier. Look at the 5-year return on the average annualized basis. 25% for our top fund is phenomenal. And this Fidelity Global Innovators, I'm sure a lot of you who do a lot of investments, I'm sure you've heard about this. But again, this is to say that we have some very good products and investment solutions in our lineup. And at Equitable, what we really bring it down to is the ease of doing business, not for just the clients, but also for our advisors. And it's with that growth spurt that we have had over the last 1 year, we have added a lot of back office operations or operators. As you can see, growth administrators, client care representatives, and operational support. So we are not just growing in terms of sales number, we're growing as a company, and we're making sure we're staffing our company to meet the needs of our clients and our advisors. We have some great digital tools. That's one of the key value propositions at Equitable. If you have any advisors here, I'm sure there's a few, and there's a lot actually, hopefully. But if you work with any other advisors who use Equitable, ask them how they find our digital tools, because it is known to be one of the best in the industry. These are just some of the remarks that some of our advisors have left recently. But we make it very easy, especially if you have adopted digital tools in your practice. We make it very easy to open up applications, to make changes to applications. And we make sure that once you are completing an application, you're not making any errors. So there's real-time error checking. It's very easy to open up an app, submit an app, keep track of an app, make changes to an app. Everything is possible here. Last but not the least, I've mentioned about how we pass on some of our benefits to our advisors who have generously partnered with us over the last few years. So we have this bonus program called the Step Up Your Wealth program. And this program essentially is based on net sales that you bring to Equitable in a calendar year. So for 2025, let's say you bring in over $250,000 of total investment net sales across sec funds, GIAs, and annuities, you will get an additional bonus of 25 basis points at the end of the year or the following year, early following year. If you do over 500,000, that is 0.5%. Anything over 750, you get an additional 75 basis points. And if you're an elite advisor with Equitable, which is $1.25 million of business coming to Equitable, you are an elite advisor and you get a 1% bonus rate on that. So imagine, listen, if you bring in $2 million to Equitable, you're getting a $20,000 check at the end of the year as just a bonus. So lots of ways to, and this is not something we're taking away from other stakeholders or clients. This is something we're just passing down from our own reserves. The Elite Advisor Program, obviously you get the financial incentives or benefits, but you also, as an elite advisor, once you bring in $1.25 million of gross deposits to Equitable, you do get some extra perks of being an elite advisor. So you get a priority phone line extension to our back office. So you don't have to wait in line. You can bypass the wait time. You get high net worth case consultations, anything over $250,000. We can bring in a tax expert and estate planning specialist to consult you and your client in those cases. And obviously, we help you in industry events, client event sponsorships, etc. You get a lot of complimentary, goodies as well from Equitable, and you also get qualified for our elite conference that we'll be hosting for the first time next year. That's it from my end. Lots of great stuff happening with Equitable. Lots of things happening around the world, as I've mentioned. The message here is stay agnostic, stay invested. I hope the learning session was helpful for you as well. Now I'll pass it on to Philippa, who's going to give you a brief update on what's happening on the life insurance side. And after that, we'll take in some questions. So Philippa, I'll pass it on to you.
Okay, well, thank you very much for that, Sadaf. Very interesting. So much happening in the world, so good to touch on it all. And thank you for that presentation. I also want to say thank you to IDC Win for your hospitality and hosting us today. We're really excited to be here. And I know I can speak for myself, Sadaf, and all of our counterparts on the insurance and the investment side at Equitable when I say we love working with the dedicated team at IDC Win and with the advisors. If we haven't had a chance to work with you yet, we'd love that opportunity. Hopefully you can tell we are passionate. We love what we do. We love what we represent. And so it'd be great to have an opportunity to work with you. So I am one of the directors of insurance sales at Equitable. I cover in Ontario. I look after the GTA area. I also look after North Ontario and East Ontario. So that's me. In the Southwest, it would be my counterpart, David Hutchison, which everybody knows as Hutch. And for those of you who are joining us today from other provinces, if you would like to find out who your dedicated director of insurance sales is, just reach out and we can make that connection happen. So we're coming to the end of the presentation, and I know we want to have some time for questions and answers as well. So I thought what I would do is just touch on some exciting enhancements to our Equimax. So Equimax is our participating whole life product. It's our flagship product. And just in Q4 of last year, we released 2 awesome enhancements. So in October and in December, I know you get a lot of emails, a lot of communications, so it never hurts to just go over, let you know about them if you missed it, or as a quick reminder about some of the really great things that we have released. Okay, so In October, two of the areas that I want to touch on are the fact that we released and added a new $5 million and up premium rate band to our Equimax, our PAR product. So clients who buy a face amount of 5 million or more really are getting more initial coverage than before with the same premium outlay. And I believe that we are the only company that has this feature. Really exciting. We also changed the commission schedule for you advisors on our Equimax, our PAR product, but also our term and our CI for clients who pay monthly. Now, commission is based on the total premiums for the policy year when monthly payment is selected. Definitely value add there, in my opinion. Then fast forward a couple of months to December, we released another batch of enhancements. What we did here was we released a guaranteed 10-pay premium option for our wealth product, our wealth accumulator. So now on both our wealth accumulator and our estate product, it's called the Estate Builder, we have life pay premium option, guaranteed 20-pay, and guaranteed 10-pay premium options. We also changed our rules a little bit that we now will allow EDO. So we call our overfunding EDO, Accelerator Deposit Option. So I know other companies, we all have our acronyms, we're EDO. We now allow EDO to be added on to 10-pay, wealth, or estate products. Before, it was a little bit more limited. We required that you add a term rider to the 10-pay to have EDO. Now you don't need that term rider, so you can have EDO there. But if you do add the term rider at policy issue and at time of underwriting, you are going to push that MTAR further. So you will have even more room for EDO deposits, which is great. We changed our EDO rules as well. They were definitely a little bit restrictive. They had some caps. It was a little bit confusing, I would say. We have made it much more flexible. And in summary, if you need more details, reach out to us. But in summary, this is the new rule. The maximum amount of annual EDO that can be allowed in a policy year without underwriting is the lesser of two. So it's either the max amount approved for at time of underwriting, or it's the sum of all the EDO payments made in the last 60 months. So this rule means that clients who choose to pay less than the maximum underwritten amount approved in any given year can return to the approved maximum amount if they've made payments in subsequent years. So it's basically a 5-year window rule. Clients will have 60 months from the date of the EDO application to make their initial EDO payment. And then they have 60 months from when the last EDO payment was made to restart EDO according to these rules. So I personally am very happy about this. And part of what's awesome about it is that they're backdating these rules as well to policies issued in the past. So reach out if you have any questions about that. We increased our quoting ability on our software. So we have a web browser software. We also have a desktop one that you can download. And it was that you could quote to a maximum of $20 million of coverage. We've changed that to 25 million. If you need higher face amounts than that, reach out to your team. We can get a special quote for you. In fact, in 2024, we actually settled a PAR policy with a $100 million face amount. So we have capacity, we have capability, we have an amazing underwriting team that has doubled in size over the last year, with a very big focus on making sure we have the right people to look after our large cases, our Asian market, but also our family market and our broad market. So we are doing some really exciting things. We're also quite often known for our juvenile PAR product. By policy count, we have the largest number of PAR policies in the industry. And this has a lot to do with the fact that our juvenile PAR product is outstanding and exceptional. In fact, the average age of our PAR fund policyholder is 32. So we have an extremely healthy age, and it has a lot to do with, we have a very diverse range of policyholders in there. of insured people as well. So we actually just released a new predictive juvenile underwriting model. It's industry leading and we're having tremendous success with it. So it facilitates faster auto approvals for juvenile apps. So here we're talking 0 to age 17. So for anyone in that age bracket, the insured up to and including a face amount of 500,000, this auto approval or this predictive underwriting model is in force. And we're seeing that the average time from submission to commission is 3 business days. That's pretty cool. So the whole idea here is to allow our underwriters to focus on the more complex cases, ease of business with us. It's really great. So to echo a little bit about what Sadaf said, we are really proud of the fact that we're the only federally regulated mutual company in the industry in Canada. To our south, there actually are quite a few. And to that end, we have no plans or ideas to demutualize in any way. This is, for us, a very, very key component and part of our offering to you and your clients is that we are mutual. So we're owned by our participating policyholders. They elect a board of directors, they vote on issues. And so our client and our company interests are aligned. We're not driven by shareholder pressures for quarterly results. If we come across a really juicy investment, we don't have to go, oh, shoot, do we put it in the PAR fund or the general fund? Should our shareholders benefit or should our PAR policyholders benefit? So it makes it very easy to keep the focus front and foremost on our clients. Every decision, we had our national sales meeting a couple of weeks ago, and Fabien Jeudi was on the stage, and he reiterated the fact that the very first question that has to be answered when any idea or proposition or change or enhancement, anything comes up is, what will this do for our policyholders? Like what is in it for them? What will be the outcome for them? So last thing I'll say is we've been in the PAR business for a long time, guys. We've had our PAR fund since 1936. We've issued dividends every single one of those years. We have no closed blocks of business. We have an outstanding dividend scale interest rate, 6.4%. And we are really transparent with our results. So we will share with you, and if any of you are interested, our historical results. And from that, you will see that the rate of return on our PAR fund fully supports the dividend scale interest rate. We don't inflate, we don't subsidize for marketing purposes. So we're really excited about what we do and really happy to be with you here today. So reach out if you need anything. That's it for me at this point. So I think we can open it up to some Q&A at this point. What do you guys think?
While we're, we have about 5 to 6 minutes for Q&A, so feel free to ask away questions. We do have some questions on the chat, which I'll address right now while we're getting more questions. So Monica has asked a great question on spousal RSPs when it comes to segregated fund contracts. How does the structure work with the spousal, with RSP, with the spouse's successor annuitant? That's a great point, because I did forget to mention, with registered contracts, in general, you can elect a successor annuitant except for RSPs. So great catch there, Monica. For RSPs, you will not be able to elect a successor annuitant. There's only a beneficiary that you can name. However, for TFSAs, RIFs, FHSAs as well, you can elect a successor annuitant. And what happens when the owner passes away is that the ownership is transferred to the successor annuitant. Now they're actually in full control of the contract, and the taxes will also be rolled over to the spouse as well upon the death of the primary owner. So good question. Surinder, next question you have is on reset. Is it offered on our 75/75? It is not offered on 75/75. Our resets are only offered on 75/100 and 100/100. Abel asked a question regarding, does Equitable still offer Pivotal Solutions product? We don't offer Pivotal Solutions. Pivotal Solutions is our legacy product. What we offer right now is Pivotal Select. It's a rebranded sec fund offering. So that's the one that we offer right now. It's has a lot more funds in it and has some great contractual benefits embedded into it as well. Ken asked a question regarding who is our life contact for BC, Philippa?
It will be Corey Murphy or Stephanie Wong. I will find out for you, Ken, and make that connection happen. No problem at all. What else is there? In the webinar chat, Sadaf, somebody said Shibu. I hope I'm pronouncing that correctly. Forgive me if I'm not. I'm used to getting my name said wrong all the time, so that's my reason. How can I get the past report on dividend amounts for the last 20 years? I will get that sent out to you. No problem at all. And it's on our website. Not that I'm sending you there to find for it. I'll send it to you, but it's easy to access as well.
And I'm seeing a lot of thank yous from both of you. So that's a great sign, guys. So those are a lot of great information. Some great stuff on the segregated fund side and a little bit of the political analysis. We're all kind of eagerly watching every day. And then Philip has some great updates on the Equimax as well on the PAR. So I know from experience, I've seen you guys have been quite competitive in some of the cases as well. So we really appreciate that. And looks like our attendees have really appreciated this as well. So yeah, I think that's it, guys. So I really appreciate it. I'll give you any final words you want to leave the group with.
Oh, good luck to you with your business this year. We're in the second month. It's been, I think I've seen so many memes about it's been the longest January ever. I think maybe that's a good thing. That means business is good, right? So good luck to you all. Please don't hesitate to reach out. We'd love to work with you.
Thank you, Brett. Thank you to the entire IDC family and also to all the advisors who've joined us today. We look forward to working with you all. So take care and have a good one.
Yeah, well said, guys. So thanks to that. Thanks, Philippa. Thanks, everybody, for joining us today. If you have any questions, let us know and reach out to your local business development executives for follow-up if you wanted to action anything with Equitable. So thanks, everybody. Have a great day.
Thanks, everybody. Take care. Bye.